The third element of accounting is owner's equity, and it's got the shortest definition, but it is the hardest one to remember. So we've got 5 elements, and we're still on the balance sheet. We've done assets, we've done liabilities, and now we're looking at owner's equity. So it's a short definition, but it's complicated. So let's have a look at that definition. What is owner's equity? It is the owner's residual interest in the assets of the entity after deducting all of its liabilities. Very clunky. It's not easy to you wouldn't say it like that if you were going to explain it to someone in person, but that is our formal definition. What does it mean though? Well, I guess it means is what is left over for the owner of the assets of the business once all of its liabilities have been settled. Now, you're not going to write this, right? But this is a good way to remember it. This is how I would explain it to someone who I was having a conversation. It's what the owner actually owns of the business, not what other entities own. What are we talking about? Well, we're going to go back a step. We're going to go back to some of the theory that we did. And the first accounting assumption was the A1 was accounting entity. What does that mean? It means the assets, liabilities, and business activities of the entity are kept completely separate from those of the personal records of the owner. So that's the really important bit. There's a couple of other bits in this definition when we don't need those now. Let's just talk about this bit here. It's this bit here that we're interested in. Fundamentally, what that is saying is this: the owner is not the same entity as the business. They're separate. That's 2 different entities, okay? So when you look at this, so if you go and get your hair cut at a hairdresser, you see this woman and she's the owner and you think, oh, she is the business. She's not. She's the owner. The business is separate. These 2 guys start a removalist business. They're not the business. They're just 2 guys. They might be the owners. And like same with this woman who owns the florist here. Different entity. They're just different in the eyes of the law. So I guess what we want to talk about is, well, who actually owns a business then? Well, the owner definitely owns the business. Okay, that sounds obvious, right? The owner owns the business. But there's this other sort of, it's not, maybe not ownership, but any party owed money by the business kind of owns it as well. We're going to talk about this more when we do the balance sheet and the equity side of it in a later chapter. But what are we talking about now? Well, let's just take an example. You want the new iPhone. It's $2,000, right? But you've only got, so let's call that an entity. That phone is an entity. You've only got $500 of your own money, but you really want the phone. So you've got $500 here. You're $1,500 short. Well, you're an entity. The phone's an entity. You're an entity. You go and get the $1,500 as a loan from your parents. They want, $100 back a month for the next 15 months or whatever, but they have loaned you the money. That is a party who is owed money for the phone, $1,500. So when you think about it, who really owns this entity of the phone? Well, you're the one that's got it in your pocket, and you're the one that carries it around and shows all your mates, but you don't actually own all of it. Right now, your parents have a claim to $1,500 of that phone, but you don't say that. You just go, here's my phone, here's my business. Well, that's not quite correct. Let's take a more complicated example, like a more realistic example. So a business is simply an entity that owns things. That's all it is. Just like you can own things, well, so can an entity. Let's take this hairdresser. It's got a $200,000 property. Let's say it's got $40,000 of equipment, like, all the chairs and the basins and so on. It's got $10,000 of combs and hair product and scissors and clippers and stuff. And she's got $50,000 in the bank. So you add all that up. What's that? 240 and 50. That's $300,000 of what we would call assets. Okay. However, most businesses start with a loan from another entity. In this case, why don't we say a party who's owed money by this business is the Bendigo Bank. To start the business, it borrowed $100,000 to finance all this stuff. So that just leaves her as the owner. So this particular woman here, her owner's equity is $200,000. What do we mean here? Well, I guess what we're saying is, if you look at this, all these things that the business owns, the property, the equipment, the combs, the money, they are assets. This debt that it owes to the Bendigo Bank, we looked at the definition of a liability, that clearly meets the definition of a liability. How much does this woman actually own of the business? How much does the owner own here? Well, that's what we call owner's equity. And in this case, it is $200,000. Now, that's all very complicated, but something we're going to do to help explain that is look at, well, when you look at it, liabilities, it's really what other parties own of the assets of the business. And when you look at owner's equity, that's kind of what the owner owns of the assets of the business. So let's say this business ended today. This owner said, I've had enough, I'm selling it, everything's got to get wound up. Well, let's look at this. The Bendigo Bank is owed $100,000. So they would be entitled to ask for the $50,000 of money, the $10,000 of equipment, and the $40,000 of fixtures and tables and chairs and stuff. They would go to the Bendigo Bank, and now their debt is settled. The owner's equity in this case, she would be entitled to the property. That's hers. Now, this is all very complicated, but it can be simplified in a relationship called the accounting equation. We're going to do this a lot. It is called assets equals liability plus owner's equity. So let's just take that business. It had $300,000 of assets equals its liabilities of a loan, which is 100, and the owner's equity in this case was 200,000. And that has to be true for everything we do for the rest of the course. We're going to talk about this a lot. But for right now, let's just go back to our definition. It is clunky, but it probably makes a little bit more sense now. This $200,000 is the owner's residual interest in the assets of the entity after deducting all of its liabilities. I guess what we're saying is she can have the property for 200,000, and the bank, they would get the rest. So why because they are separate entities, just one little topic that's going to come up a lot that we need to talk about is because the owner and the business are separate, well, they can kind of do transactions with each other. So when the owner can give the business money, a car, property, anything that's an asset. Now, when the owner does that, that is called a capital contribution. When the owner gives assets to the business, and it's got a funny title, capital contributions, but basically what we're saying is the owner is contributing to the equity of the business. They're giving the business an asset. But that goes both ways because the business can also give assets to the owner. That is called drawings. That is when the owner takes assets from the business. They are withdrawing their equity. Now, that sounds bad. You're taking a car for the business. Well, that's your right as the owner. You're allowed to withdraw your capital. The thing to remember now is when we do that, it doesn't just have to be money. That's the most common example we'll deal with. But the owner can take out drawings in the form of cash, car, property, or any asset that the business has.